So, what is going on with South Korea's economy right now? Well, it's at this huge critical crossroads. Its central bank is basically walking a tightrope, and believe me, one wrong move could have some pretty massive consequences. We're going to break down this whole high-stakes balancing act and what it all means.
And this really gets to the heart of the puzzle, you know? With parts of the economy practically screaming for help, why on earth is the Bank of Korea hitting the brakes? Why are they holding back on interest rate cuts when so many people thought they'd be flooring the accelerator? It's a huge decision.
Okay, so let's get right to it. What was the big verdict from their latest policy meeting?
And the answer is they're holding. For the fourth meeting in a row, the bank has decided not to cut its key interest rate. This isn't just a one-off thing anymore. It's a pattern, and it signals a very clear strategy of caution.
The magic number to keep in your head is 2.5%. That's the rate they're sticking with. But the real question is, why this number and why now? Well, it turns out they are completely caught between a rock and a hard place, juggling some seriously conflicting pressures. And that brings us to the first massive problem, and it's a big one. We're talking about the immense pressure coming from the South Korean housing market, what some very, very senior officials are calling a time bomb.
I mean, just listen to that language. This isn't your typical dry economic talk. When the country's president is calling the housing market a ticking time bomb, you can bet the central bank is paying very close attention.
And this isn't just talk. The numbers are pretty alarming. Take a look at this. Housing prices in Seoul are jumping by 0.2% every single week. Now that might not sound like a lot, but it adds up fast to a 3.4% annual increase. A rate cut right now would be like pouring gasoline on that fire.
And even the Bank of Korea's own governor is admitting this price surge is well above expectations. So you've got the government and the central bank on the exact same page here. The housing market is overheating, and cutting rates is just way too risky.
But you know, if it were only about the housing market, this would be an easy decision. But it's not. The broader economy is sending some seriously mixed signals, creating these powerful cross-currents that are incredibly difficult to navigate.
This is fascinating. It's like a tale of two different economies inside one country. On one side, you have the AI chip sector, just absolutely booming. Exports there are up an incredible 15% from last year. But then you look at everything else, the non-IT exports, and they're barely growing, getting hammered by US tariffs and soft global demand. It's the classic central banker's nightmare. Do you cool down the hot parts or prop up the weak ones? And just when you think it couldn't get more complicated, guess what? There's another problem pushing against a rate cut. Inflation is starting to creep up again.
Yup, October's inflation numbers hit 2.4%, with the core number at 2.2%. That's the fastest it's risen in over a year. And while it might not be their biggest worry, this upward trend gives the bank yet another really good reason to just hit pause.
So we've got the housing issue, we've got inflation, all these domestic challenges. But the Bank of Korea doesn't operate in a bubble. It's also being squeezed by these intense forces from outside, what you could call a global pressure cooker.
The biggest factor here is the U.S. Federal Reserve. The Fed is basically signaling it's going to stay hawkish, which means it's not likely to cut its own rates soon. That puts a ton of pressure on currencies like the Korean won, which just weakened past the 1470 mark against the dollar. That number definitely sets off some alarm bells.
And here's exactly why that matters. If the Bank of Korea were to cut its rate now, it would just make the gap with US rates even bigger. That would make the won even less attractive to investors, and the currency would probably weaken even more. So they're basically boxed in, forced to play it safe to protect their currency.
So given this perfect storm, a hot housing market, mixed economic data, rising inflation, and a tough global environment, what does the road ahead actually look like for South Korea? Well, not surprisingly, all of these challenges have forced market analysts to completely rip up their old predictions and rethink when the Bank of Korea might finally feel comfortable enough to start cutting rates again. Just look at this table. You can see the shift right there. Before, the market was betting on rates dropping all the way to 2% by early 2026. Now, the forecast has them staying higher, at 2.25%, all the way through the end of that year. The big takeaway? The market now believes rates are going to stay higher for longer. The era of super cheap money isn't coming back as fast as people hoped.
Now, it's not all bad news. The outlook for economic growth has actually improved a little bit.
The 2025 forecast is now up to 1.1%, mostly thanks to those strong AI chip exports. And if we look out to 2026, growth is expected to get a bit stronger, hitting 2.1%. Still, it's a slow and steady climb back.
Which brings us right back to where we started. The Bank of Korea is walking this incredibly thin tightrope. They're balancing that housing time bomb, a split personality export market, rising inflation, and a hawkish US Fed. So the big question is, can they actually pull it off? Can they navigate all of these crosscurrents, or is this pause just the calm before a new wave of economic turbulence?